it would make a lot of sense for gold to just pull back to this level here, this 3,500 level, which should be really, really good support. And in all fairness, it could take up to 2 to 3 months. So maybe by end of year, we're still kind of struggling here. But then the positive is it's gathered its strength and can make its next push. And by that point, my guess is this upsloping parallel gets closer and closer to 4,000. And I think the next target then is $4,000 an ounce on gold. I do think it's destined to get back to that $50 level, which was the high in 2011, technically just below 50. And I actually think eventually it's going to go higher than 50. But in the meantime, look for consolidation, small pullback here at 44, and then eventually a breakout in the next couple months towards that $50 level.
Gold's explosive rally has caught the attention of traders everywhere, but after such a steep climb, the charts suggest the metal may be ready for a pause rather than another immediate surge. Gareth Soloway emphasized that gold's recent touch of a key trendline mirrors earlier market behavior, particularly the April-August consolidation that preceded a powerful breakout. This consolidation, while it may frustrate short-term traders, serves as a reset that strengthens the underlying bull trend and prepares the path toward the next major upside objective near $4,000. Building on that view, he highlighted how past patterns reinforce the current outlook. The last time gold neared all-time highs, it formed a bullish wedge pattern that led to sideways action before the rally resumed. A similar setup now suggests that a pullback toward the $3,500 area is possible, yet it should be seen as part of a broader consolidation rather than a reversal. From this base, Soloway maintained gold is positioned to break significantly higher, potentially reaching as far as $6,000 in this ongoing bull cycle. This perspective also underscores the importance of long-term trend lines when gold enters uncharted price territory. At record highs, traditional support and resistance zones are less reliable, but ascending parallel trend lines can still provide critical guidance. Pullbacks that occur when early buyers take profits are not necessarily bearish, but represent natural pauses in a rising market. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
Yeah, that's a great point. So per the charts, we are getting to a point where we're getting extended, and I'll bring up my charts to show here. Number one, one of the last times we talked was right around this all-time high here. And we did see from that point what's called bullish consolidation. And essentially, if we connect these highs and these lows, you get what's called a bullish wedge. And so this was telling us that price had run so much from December of 2024 into April 2025 that it needed to digest the move to gain strength for its next breakout. And sure enough, it broke out recently, and look at what it's done since it broke out. I mean, just straight up vertical move. If you've been a gold bug for a long time, you know that gold tends to not move so vertically. So in general, it's actually healthy to see it pull back a little bit. And so one of the things I discovered on the charts, and this is really kind of cool, I use parallels to give myself resistance levels. And so what I did here is take the low from 2024, basically when the bull breakout began. If we zoom back out, you can see that in 2021, we went sideways. We kept on hammering on this $2,000 level over and over again, hammering. And then finally in 2024, we broke out. So let's use that low and connect it through the lowest point, which is right down here, right here. All right, and that's in December of 2024. We bring a parallel all the way up to that previous all-time high, and look at what we get. We get the high here, and then we had that base of consolidation, and look at what we kissed today. And so based on this tells me that at least we should go into what we would call a consolidation period or digestion period, which generally is a small pullback on gold as it kind of gets ready for its next move. So I still think there's upside on gold into next year and beyond, probably as high as $6,000 in this bull run. But you just have to be cognizant that charts very rarely go straight up. And if they do go straight up, they pull back harder. So here in gold's situation, let's look for a pullback, maybe as low as 3,500, and then the next leg to the upside can start. Yeah, so based on this hit on this trend line, what we're likely to see is that gold will now go into a period of sideways chop, probably pretty similar to what we saw over here, which again, if you're a long-term bull, you don't mind this because it's just digestion. We all like to be paid out fast if we're long gold, but it's healthier to see these kind of consolidation periods. And this one lasted from April all the way until basically August before the big move up. And so I think it's very possible we could see in the next quarter something very, very similar. And what I like to do is if we just extend this out here and bring this up a little further to look out into the future, I would generally look for sideways chop that could take us back to the previous high. So in technical analysis, what's so fascinating is that once we break out above a previous all-time high, like from April, there's a tendency to want to come back to home base. And home base is the previous high where you saw a lot of consolidation. And so in reality, it would make a lot of sense for gold to just pull back to this level here, this 3,500 level, which should be really, really good support. And in all fairness, it could take up to 2 to 3 months. So maybe by end of year, we're still kind of struggling here. But then the positive is it's gathered its strength and can make its next push. And by that point, my guess is this upsloping parallel gets closer and closer to 4,000. And I think the next target then is $4,000 an ounce on gold. When you go to new all-time highs, you're essentially in uncharted territory. It does make it harder to find levels, but that's where you start breaking in these upsloping trends, right? So on gold, for instance, we have this longer term parallel, which allows us to bring this trend line up, and it actually gave us the recent high that we just kind of kissed today on gold. So you don't have as much at your disposal because you don't have as much history in this area, but again, you still can find something. And even when you're in uncharted territory, there's going to be a pivot point where there's a certain amount of buyers that bought and they're happy enough with their gains and they're going to sell into that. And so you will get a pullback. It's up to us as technicians to figure out at new all-time highs, where is that going to be? And again, things like the parallel, the upsloping or ascending parallel is a great tool for that. Yeah, so this is such a cool chart because it showcases a principle that I use in technical analysis called as above, so below. And what you have here is a very defined trend line on GDX. It goes back to October of 2024, and then we kind of fell back down here. We made our way back to the trend line. We pulled back. We kind of got back there again, pulled back. We came up right here, pulled back, and then broke out. Now, this as above, so below technique, essentially what you do is you say, well, what was the furthest I was below this trend line, which is obviously an important trend line in recent history. And really that would be probably right here, right? This is the furthest you were away from that trend line when it pulled back here. And if you kind of drag that across, you can see that there's no other real point that was further away. And what you do is you say, okay, well, if that was the furthest away to the downside, then my upside target should be equal to that. And what's so cool is that if we take that and we put it right to the line, look at this, guys. Literally like the high today on GDX went right there, and then GDX has started to sell off. And so just like gold is hitting that upside resistance, you're now looking at downside on GDX because it has achieved its target. And it makes sense that if gold's going to pull back a little bit, probably the gold miners will pull back a little as well. Just like with gold, I would be a buyer. Like at some point, if this ever pulls back to this orange trend line, I'm buying that, though. That would be the buying opportunity. Yeah, the Fed is in such a tough spot right now. So, number one, Powell, you're right. He also called out the stock market today, saying that the stock market is very expensive and it's actually adding to inflation. That's called the wealth effect, kind of something I talked about, how it's making the consumer spend more because they're feeling so wealthy from looking at their 401k and their investment accounts. But Powell is at a point where he would love to cut rates more, but between tariffs and the stock market, he doesn't want to see inflation shoot back to 7, 8, 9% here in the US. And so he has to take it slow, because I think the way he looks at it too is that who does inflation affect the most? You know, well, wealthy people who are in the stock market, like even if the stock market drops 10%, wealthy people aren't going to feel it, right? But if inflation goes to, let's say, 7% or 8 or 9 or 10%, everyone who hasn't participated in the rally in the stock market that is already struggling because of inflation, they are going to be decimated. And so I think he has to err on the side of caution here. I know everyone in the markets were like, oh, come on, cut rates so much so the stock market just keeps going up. He has to really look at it from a bigger, what's good for society. And really that is to be a little bit more cautious on cutting rates. Now, listen, is it going to hurt the economy? Yes. But again, it's would you rather? I mean, which one's the better odds here, or which one's the better play? And it's a tough decision.
Gareth Soloway highlighted silver's recent breakout, noting how it often follows gold's lead during major rallies. Although he was initially cautious because of silver's industrial exposure and the risks tied to a slowing economy, the price surge has shifted his outlook. He pointed to the $44 level as a key resistance tied to the 2011 peak, suggesting that a near-term consolidation or pullback is likely after such a sharp advance. Still, his broader view remains bullish, with expectations of silver retesting the $50 mark and eventually pushing towards $60 within the next 6 to 12 months, representing nearly 50% upside potential. At the same time, he connected silver's trajectory to broader market conditions, warning that the disconnect between a weakening U.S. labor market and the S&P 500's strength signals fragility. The Nasdaq 100 is flashing red flags, with its trendline history pointing to the risk of a significant correction. In this environment, he suggested that capital rotating out of overvalued equities could further benefit precious metals. A short-term pause in silver may be healthy, but with gold's momentum and economic cracks emerging, the setup remains favorable for silver to climb toward new highs. Let's get back to the interview.
Yeah, and silver has broken out, and so granted it did go into some resistance. I'll discuss that. But until it broke out, I was a skeptic, just because, again, if the economy is weakening and it's partially an industrial metal, those are all things. But ultimately, when gold, think about this, gold gets so extended away from silver that eventually it pulls silver behind it. And I think that's really what we've seen here lately. But one of the things I love to show here is that you had this kind of upsloping trend line here. And you can see that essentially every time we would hit this line, and you can see it right here, I'm going to use a little directional signal. So here and right here and all along this area, we just kept on getting rejected. Finally, they got us above, and that's where we've gotten this beautiful run. So now we did come into a resistance at $44 per ounce. The resistance here comes from a pivot high in 2011 right here, and this was the second highest high, right? And so this was in August of 2011. So just on a technical analysis basis, this gives us a point where after this really good silver run, it should take a breather. But I actually am bullish now on silver after we take that breather. It would make a lot of sense for gold to just pull back to this level here, this 3,500 level, which should be really, really good support. And in all fairness, it could take up to 2 to 3 months. So maybe by end of year, we're still kind of struggling here. But then the positive is it's gathered its strength and can make its next push. And by that point, my guess is this upsloping parallel gets closer and closer to 4,000. And I think the next target then is $4,000 an ounce on gold. So on silver, I'm not triple for, and then again, this is the next 6 to 12 months. So keep in mind, if we talk about where this is in 5 or 10 years, that's a different story. But just in, let's say, 6 to 12 months, what I've done here is basically say, okay, well, if we have, let's use our parallel again, just like it just predicted that gold move. If we zoom out to our monthly chart and we go back to the low of the last bull run, which started basically in 2001, 2002, and then topped out in 2011, and then to this low here, right through these levels. And let's draw that trend line in, all right? So we can see here that essentially we have a point where every pullback kind of chops around. This one outlier right here where we dipped below, that was the COVID collapse. And so I refer to that one as an outlier because it was just all out panic. We saw oil at that time, oil actually went negative. The current month contract was like negative $40. They were actually paying you to buy oil at that point, or to take oil. Now, granted, you had to figure out where to store thousands of barrels of oil, because if you were going to buy it, that's what you had to do. But the point being is that notice how it reestablishes right here. And so what then we want to do is we want to say, okay, well, in this bull run, if we drag this up to our previous high, which was the 2011 high, where does that parallel extend out to? And it goes to $60. And so for me, at least in the next 6 to 12 months, I would say there's almost 50% upside on silver here to about a $60 handle. You know, we continue to see a U.S. labor market that is weakening. The markets, the stock market itself is absolutely ignoring it, but that's very normal. And I'll throw up the S&P chart here just to kind of show you guys what we're seeing here. So the S&P is just coming off all-time highs. It's down a little bit today, but for the most part, the economy is weakening. You've had this bigger and bigger divergence between the haves and the have-nots. And I'm sure a lot of viewers out there can appreciate what I'm going to say here is that if you've been an investor and you have a lot of money invested, you're weathering inflation, couldn't care less about X, Y, and Z. You're fine with home prices where they are. You probably have a home and prices have gone up substantially. Everyone else, even some of the middle class, is getting left behind and they're really struggling. Some stats that really are shocking. You know, we have credit card delinquencies of 90 days or greater. It's now as high as it was in the Great Recession financial crisis. Buy now, pay later. We've heard about buy now, pay later. 25% of the people using buy now, pay later are using it to buy groceries. And that's just not a good thing, right? That is not a healthy thing. Now, listen, the high end, they're still buying their Ferrari, right? I mean, the stock market keeps making all-time highs. Bezos keeps building more yachts, right? I mean, all these type of things. But over time, as soon as the stock market starts to have a correction where we don't make new highs in a month or 2 months, the economy is at a pivot point where it will slip very quickly. You're going to see then the high-end consumer start to pull back, and that is the last straw for this economy. So I do think that, again, we're teetering. As long as the stock market makes new all-time highs almost daily, okay, the economy itself, the GDP numbers can hold up, but a large portion of this population are really struggling at this point. Other caveat is something that's already starting to happen, which is housing, right? So if you're on the higher end and let's say you own a $700,000, $800,000 home, some places that's still low end, but the point being is you've been used to basically making 50K to 100K on that home for the last few years as prices have just gone up and up and up. At least here in Florida and some places in the southern states, we're seeing a huge slowdown with prices starting to plummet. And as people look at their net worth, we all think, okay, well, I have X amount in cash, I have X amount in stocks, and oh, look, I'm really wealthy because my home is worth X amount, right? 800,000, a million, whatever it may be. If that number starts to come down, which it is here in the South, and it's starting to stall out in other areas, that will also take a psychological impact on investors and consumers and start to slow their spending. In the short term, we're looking at probably over the next month. In fact, I have it priced in for about a 10% correction in October. We might have started that today. With this move to the downside. I did want to show you guys something on the QQQ, the NASDAQ 100. There's a trend line here, and you guys know, I mean, from everything I do, it's all trend lines. None of these fancy, like everyone else uses these crazy indicators. I'm like, dude, I just keep it simple, right? But if we look at this on the NASDAQ 100, this is the low from COVID. So it's obviously a major low. I mean, it was literally the low from COVID, the COVID collapse. And from there, we've gone up except for the bear market in 2022 and the Liberation Day sell-off. If you take that and you stretch it out here, it goes right through this little dip in March of 2022. We bounced there. We broke down. And then look, every time we hit the trend line, we get a decent corrective move. And so the idea is look at where we are now. We're right back to that trend line. So just looking at and mapping this out, from this high to this low, it was a 16% correction. From this high to the COVID low, it was about 25%. You know, it's hard to go out and be like, oh, we're due for a, let's average those and say 20%. I think that's a little aggressive considering the buy the dip mentality. But could this be the start of a 10% pullback? I think very, very likely. And then if things really deteriorate in the economy, we could be looking at a much bigger scenario a la .com. And I do think that you can't overestimate how bubblicious AI stocks have gotten to the point where the semiconductor sector, so just a sector, is now valued at $10 trillion in the US in terms of market cap. That literally would make it, if the semiconductors were a country, they'd be the third biggest country in the world behind the US and China. I mean, it's gotten insane. at this point. One other thing to point out here is there's a stock, OKLO. The stock today is up again today. It has run from $66 on September 8th to now $143. This company makes zero revenue. They're just on the process of breaking ground on some nuclear plants. Generally, this is going to be something that's commoditized, meaning it's like an electric, grid type thing, but it's getting priced like one of the hottest tech stocks out there. That again is very reminiscent in my early trading years when someone would just add a .com to the end of their company and their stock would go up 200%. Or something like that. So it's very similar where there's the valuations, the fundamentals make no sense. Investors are telling me that this time is different. Every time I hear that, I get very nervous because it always ends up not being different, even though we think it might be different. And it's just very similar to the .com, and that's scary.
Against this backdrop, gold and silver stand out as assets capable of weathering turbulence and preserving value when speculative bubbles begin to deflate. While equities, particularly in overheated sectors, appear increasingly fragile, precious metals offer stability grounded in scarcity and intrinsic worth. Gold continues to act as the anchor of safety during periods of financial stress, while silver's dual role as both an industrial and monetary metal positions it for outsized gains if investor sentiment shifts away from risk-heavy assets. As markets face the possibility of correction and the fading of the this time is different narrative, both metals remain strategic hedges that can provide resilience and opportunity when other investments falter. Given the growing risks of market corrections and inflated valuations in certain sectors, could gold and silver attract renewed institutional inflows as investors seek stability outside of equities? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thanks for your support, and we hope you enjoy the video.